Hi. Let's learn about the bearish engulfing pattern. A bearish engulfing pattern is a technical chart pattern that signals lower prices to come. The pattern consists of an up candlestick followed by a large down candlestick that eclipses or engulfs the smaller up candle. This can be important because it shows sellers have overtaken the buyers and are pushing the price more aggressively down than the buyers were able to push it up. A bearish engulfing pattern is seen at the end of some upward price moves. It is marked by the first candle of upward momentum being overtaken, or engulfed, by a larger second candle indicating a shift toward lower prices. The pattern has greater reliability when the open price of the engulfing candle is well above the close of the first candle, and when the close of the engulfing candle is well below the open of the first candle. The pattern is also more reliable when it follows a clean move higher and less significant in choppy markets. The chart example shows three bearish engulfing patterns that occurred in the Forex market. The first bearish engulfing pattern occurs during a pullback to the upside within a larger downtrend. The next two engulfing patterns are less significant considering the overall picture. The price range of the Forex pair is starting to narrow, indicating choppy trading, and there is very little upward price movement prior to the patterns forming. A reversal pattern has little use if there is little to reverse. Within ranges and choppy markets, engulfing patterns will occur frequently but are not usually good trading signals. These two patterns are opposites. A bullish engulfing pattern occurs after a price move lower and indicates higher prices to come. The first candle, in the two-candle pattern, is a down candle. The second candle is a larger up candle, with a real body that fully engulfs the smaller down candle. Engulfing patterns are most useful following a clean upward price move as the pattern clearly shows the shift in momentum to the downside. If the price action is choppy, even if the price is rising overall, the significance of the engulfing pattern is diminished since it is a fairly common signal. The engulfing or second candle may also be huge, leaving a trader with a very large stop loss if they opt to trade the pattern. Establishing the potential reward can also be difficult with engulfing patterns, as candlesticks don't provide a price target. Here are 4 key takeaways. 1. A bearish engulfing pattern can occur anywhere, but it is more significant if it occurs after a price advance. This could be an uptrend or a pullback to the upside with a larger downtrend. 2. Ideally, both candles are of substantial size relative to the price bars around them. 2 very small bars may create an engulfing pattern, but it is far less significant than if both candles are large. 3. The real body, the difference between the open and close price of the candlesticks is what matters. The real body of the down candle must engulf the up candle. 4. The pattern has far less significance in choppy markets. Hope this would help. Thanks for watching.